Today, we are continuing our live market commentary and detailed analysis of the EUR JPY trading strategy. This is strategy number 1, day 2, and throughout this session, we will observe how the rules perform under real market conditions. The strategy operates within a clearly defined trading window, beginning at 12 a.m. and ending at 7 p.m. London time. The chart is set to a 10-minute time frame, which means each candle represents 10 minutes of market activity. Using a fixed time frame and a fixed trading window helps us maintain consistency and prevents emotional or discretionary decisions from interfering with the process. At the beginning of the trading window, we identify the market price at exactly 12 a.m. This price becomes our reference point. Once the reference point has been marked, we place 2 pending orders around it. The first pending order is a buy order positioned 15 pips above the reference price. The second pending order is a sell order positioned 15 pips below the reference price. The upper order prepares us for a bullish breakout, while the lower order prepares us for a bearish breakout. The purpose of placing orders on both sides of the reference point is to avoid predicting the market's direction. Instead of assuming whether EUR JPY will move higher or lower, we allow the market to make that decision for us. Whichever level is reached first determines the direction of the trade. Each order uses a stop loss of 30 pips and a take profit target of 60 pips. This gives the setup a reward to risk ratio of 2 to 1. In other words, the potential profit is twice the amount initially placed at risk. Both pending orders remain active until one of them is triggered. As soon as one order becomes an active trade, the opposite pending order must be removed immediately. For example, when the sell order is activated, the buy order above the reference point is canceled. Similarly, when the buy order activates, the sell order below the reference point must be removed. This is an important part of the strategy because the 2 pending orders represent a single trading opportunity. They are not intended to create 2 separate positions. Once the market chooses a direction, only that active position should remain. When the active trade moves sufficiently into profit, the stop loss is adjusted to the entry price. This is known as moving the stop loss to break even. Once the stop is positioned at the entry level, the original trading risk is removed, subject to normal market spread and execution conditions. After moving the stop to break even, we allow the trade to continue developing. We do not close the trade simply because the price pauses or makes a temporary pullback. The position remains open until it reaches the take profit target, returns to the break-even level, hits the protective stop, or reaches the end of the trading window. The timing of the next setup depends on the result of the previous trade. When a trade finishes in profit, we wait for the next complete 10-minute candle. The closing price of that candle becomes the new reference point, and 2 fresh pending orders are placed 15 pips above and below it. When a trade finishes in a loss, we do not immediately enter another setup. Instead, we wait until the next full hour before establishing a new reference point. This delay creates a cooling off period and prevents the strategy from repeatedly entering during unstable or unfavorable market conditions. The same process is repeated throughout the session until the trading window ends at 7 p.m. London time. The rules remain unchanged, regardless of whether the previous trade was profitable, unsuccessful, or closed at break-even. Now we move to the chart for the 2nd of July, which represents day 2 of our strategy test. We begin by drawing a vertical line to identify the start of the new trading day. At exactly 12 a.m., we mark the current market price with a horizontal line. This becomes the first reference point for the session. From this reference level, we place the buy order 15 pips above and the sell order 15 pips below. Both orders are prepared with a 30 pip stop loss and a 60 pip take profit target. Once everything is positioned correctly, there is nothing more to do except wait patiently and allow the market to reveal its direction. Between midnight and approximately 7 a.m., EUR JPY does not produce a strong directional movement. At times, the price trades above the reference point, and at other times it moves below it. However, neither pending order is activated during this period. This is an important example of why patience is essential. The presence of market movement does not automatically mean that a valid trade has occurred. Until one of our predetermined entry levels is reached, we remain outside the market. At approximately 7 a.m., strong bearish momentum begins to develop. The price moves decisively lower and activates the sell order positioned below the reference point. As soon as the short position becomes active, the unused buy order is removed. The bearish momentum continues after the entry. The market moves steadily toward the profit target, and within approximately 40 minutes, at around 7:40 a.m., the price reaches the full 60 pip take profit level. The first trade of the day therefore closes with a profit of 60 pips. This is an excellent example of the strategy working as designed. The reference point was established in advance. Both possible directions were prepared. The market selected the short side, the opposite order was canceled, and the trade was allowed to continue until the predetermined target was reached. Because the trade finished in profit, we now follow the profitable trade reset rule. We wait for the next 10-minute interval and use the completed candle to establish a new reference point. 2 new pending orders are then placed around this updated reference level. Once again, the buy order is positioned 15 pips above the reference, and the sell order is positioned 15 pips below it. The stop loss remains 30 pips, and the take profit target remains 60 pips. The market again moves in a bearish direction, activating the sell order. The unused buy order is removed immediately. This second trade begins moving into profit and reaches approximately 30 pips of positive movement. Following the trade management rule demonstrated in this example, the stop loss is moved to the entry point, protecting the position at break even. At approximately 10 a.m., the direction of the market begins to change. The earlier bearish momentum weakens, and the price starts moving upward. Eventually, the reversal reaches the break-even level and closes the trade. The second trade therefore ends without a profit and without a loss. Although it did not reach the 60 pip target, it also did not reduce the trading balance. A break-even trade should not be viewed as a failure. The trade initially moved in the expected direction, allowing the risk to be removed. When the market later reversed, the break-even stop protected the account. Capital protection is an important part of long-term trading discipline. After the second trade is completed, we again wait for the next 10-minute interval and establish another reference point. 2 fresh pending orders are placed using exactly the same measurements and risk management rules. This time, the sell order is activated once again, and the unused buy order is removed. The market continues to show a bearish tendency, although the movement is much slower than it was during the first trade. This is another important lesson. Not every valid trade develops with strong momentum. Some positions reach their targets quickly, while others progress slowly and remain active for several hours. The trader's responsibility is not to force the market to move faster. The responsibility is to follow the predetermined rules. The third trade remains active until the end of the trading window. At 7 p.m. London time, the position is showing approximately 15 pips of profit. Because the trading session has reached its scheduled closing time, the position is closed, securing the available gain. The third trade therefore produces a profit of approximately 15 pips. We can now review the complete performance for day 2. The first trade generated 60 pips of profit. The second trade closed at break-even, producing neither a gain nor a loss. The third trade generated approximately 15 pips of profit. The total result for the day is therefore 75 pips of profit, with no losing trades recorded during the session. We can now transfer the result to our tracking spreadsheet. The account begins day 2 with a balance of approximately 1,248 euros, carried forward from the previous trading day. Based on the selected contract size of 3.8, the 75 pip result converts to a displayed profit of approximately 465 euros. After adding the day 2 profit, the closing account balance is approximately 1,740 euro, allowing for the figures and rounding shown in the spreadsheet. This was a very positive trading day, but the most important result is not simply the number of pips or the increase in the account balance. The most important result is that the strategy was applied consistently. We established the reference points at the correct times. We placed the pending orders at the correct distances. We removed the opposite order after activation. We used the predetermined stop loss and take profit levels. We protected an open position at break even, and we respected the 7 p.m. London time cutoff. The first trade demonstrated the value of allowing strong momentum to reach its full target. The second trade demonstrated the importance of protecting capital when the market reverses. The third trade demonstrated how a slower position can still contribute positively when managed with patience and discipline.